Hey guys, welcome back to Stacking Stocks, and many thanks for tuning in today. We're going to talk about NEO, the fundamentals of the company, the stock price, why it's currently a bit lackluster compared to its competitors, what might be the prevailing reasons behind it, and why we think NEO is the most interesting investment opportunity on the block for investors. Investors are debating if this is a good time to buy the stock. Where some feel the stock is trading at attractive valuation multiples and that it offers a significant upside from its current levels, others believe the pain isn't over yet due to the risks associated with investing in Chinese stocks. Do you own NEO stock shares? In today's session, we'll cover both the bearish and bullish narratives surrounding NEO stock. Well, sit tight and stay tuned. We're about to hit the ground running. So let's begin with a one-year chart that clearly shows that Tesla is currently in a stage of overperforming the competitors like Xpeng, Li Auto, and NEO. If we go on an even shorter time span, you'll see that Li Auto, Xpeng, as well as Tesla are seemingly in sync and have performed quite well during the last 6 months in comparison to NEO. But all of this changes relatively quickly. There have been several factors creating a bit of tug-of-war with the stock of Chinese electrical vehicle maker NEO in the past several weeks. Since late October, the company's American depository shares have swung from the high 30s into the low 40s and back several times. Some of the bullishness in NEO shares has come from excitement created by other EV makers in both the US and China. But NEO shares themselves have had some overhang recently as the company worked to complete an at-the-market offering seeking to raise $2 billion. With the announced completion of the sale of the additional ADSs, attention should turn to upcoming catalysts. Many market commenters have been anticipating NEO's growth momentum to fizzle out as it scales its business, wades through semiconductor shortages, and faces intensifying market competition. However, none of these factors seem to have dented the company's delivery growth trajectory, at least not on a standalone basis. The electric vehicle manufacturer delivered 24,439 vehicles during the third quarter in 2021 alone, which was up 100.2% year over year and up 11.6% sequentially, and in range with its management's original guidance of 23,000 to 25,000 vehicles. What's even more interesting is the fact that its deliveries grew across all three of its vehicle models in spite of the ongoing semiconductor shortages. This all-rounder performance is a commendable feat on its own. NEO's revenue figures have surged to record levels in tandem with its record deliveries in prior quarters. This correlation between the two figures suggests that NEO isn't sacrificing its average selling prices, at least not materially, in order to maintain its delivery growth momentum. Also, the fact that NEO's revenue has been growing rapidly across its reportable segments without exhibiting any signs of cyclicality suggests that there's a healthy demand for its vehicles and its ancillary services. So NEO's revenue growth momentum could remain intact in the near future as well if it just maintains its average selling prices, quickly ramps up its production, and meets the ever-growing demand for its vehicles. NEO also officially announced a strategic partnership with Shell. The joint effort in China will start with 2 pilot sites with a goal to reach 100 sites by 2025. From this partnership, consumers can have access to Shell Recharge high-speed charging at NEO locations. Meanwhile, battery swapping services will also be available at convenient Shell locations. With charging and battery swapping at more locations, this would almost certainly offer a better experience to EV owners. And this is crazy. But NEO's management isn't stopping just there. The company expanded its operations into Norway. It's scheduled to launch a new luxury-centric ET7 model next year, and it's also preparing to enter the mass market segment with 2 undisclosed models under a separate brand. Overall, the company's management is making strides to maintain its lofty revenue growth momentum, and it's really no wonder why growth-seeking investors across the globe have NEO in their portfolios. However, NEO shares are trading at significantly lower valuation multiples compared to their prior levels. Where the stock used to trade at over 33 times its sales till a few months ago, it's now trading at just 12.1 times its sales. This significant contraction in valuation multiples makes NEO seem like an attractive growth at a reasonable price opportunity. But the electric vehicle manufacturer also has its share of risks involved. One of the largest risk factors surrounding NEO's U.S.-listed stock is its variable interest entity, or rather VIE structure. This structure doesn't provide any shareholding into the actual company. It's not permitted under Chinese law, and there's no telling what will happen to NEO's shares going forward. Maybe Chinese regulators openly embrace the VIE structure and make it legal without any repercussions, or they ban it altogether and consequently make NEO's U.S. listed shares worthless, or they just impose a one-time or recurring penalty on all the companies making use of the VIE structure. This lack of certainty about how the U.S. listed NEO stock will get impacted and also to what extent makes it a risky stock to own. We mentioned earlier that NEO is planning to launch a new ET7 model under its NEO brand, enter the mass market segment with 2 additional vehicle models, and it's also expanding its operations in Europe. This may seem like a sure-shot way to rapid growth, but it's also bound to inflate the company's R&D and marketing expenses. Also, if the company has to deploy separate production lines and has a low overlap, particularly less than 60% in parts, then it will result in diseconomies of scale. Some investors believe that this is not the optimal time to expand internationally, considering that shipping rates from China to Europe have nearly quadrupled over the last 1 year alone. Well, let us know what you think in the comments section. Altogether, these initiatives can significantly add to costs, weigh down on NEO's margin profile, delay its break-even point, and maybe also result in more shareholder dilution. As a reminder, NEO isn't yet profitable on a net basis. It's also important to note that NEO's delivery growth seems impressive on a standalone basis, but it actually underperformed peers once again during the third quarter. To put things in perspective, XPeng and Li Auto reported a quarter-on-quarter delivery growth of 48% and 43% respectively in the same time frame. This begs the question, why invest in NEO stock when his rivals XPeng and Li Auto are registering an even faster growth in deliveries? NEO may seem undervalued on a standalone basis, but it's actually trading at higher valuation multiples compared to Li Auto and XPeng once we factor in their forecasted 2-year revenue growth. This is another point worth considering when deciding to invest in electric vehicle stocks. Why go with NEO when its other Chinese peers are forecasted to grow at a faster rate and are available at a relative discount? NEO no doubt manufactures some of the finest electric vehicles in today's time, and it's also growing rapidly as a business. However, the point we're trying to make is that NEO's U.S. listed shares pose some serious risks for its shareholders. We just don't know if the stock will reach $25 first or if it will touch $50 levels first. Due to this heightened uncertainty, risk-averse investors may want to avoid investing in the name altogether for now. Investors that can stomach lots of volatility and understand the serious risks of investing in Chinese stocks may want to consider investing in XPeng and Li Auto for diversification purposes. These mentioned peers are forecasted to grow faster than NEO, but are still trading at a relative discount. So what is it going to be? Well, we'll leave that decision to you as an investor. Our part is to research the stocks and give out the facts as they come. Remember that despite all the risks involved, NEO still has massive potential to grow and bull. Once again, thank you for joining us today. Remember to like, share, and subscribe. Stay safe and see you next time right here on Stacking Stocks.